Hello, and welcome to the Smart Money Simplified podcast with your host, Brent Mikosh. Brent, good to be with you again. How are you?
I'm doing great, Bill, and it's great to see you as always. And I'm really excited about our guest today. We've got Steve Pointer. He's a regional director for Cantor Fitzgerald Investments. And we're going to be talking about something that I think is often overlooked. You know, the power grid, how we get water, all the
Mm,
infrastructure around us. This is the stuff that makes day-to-day living in our society, possible, quite frankly. And there are avenues and there are ways that we can invest in these types of situations, I guess,
yeah.
unique situations. And we'll add into that too, perhaps if we have time, looking at real estate and some of the tools that are in the arsenal investing in real estate as well. But we got a lot to talk about. I will say Steve is one of the smartest guys that comes into my office, and I am really, really excited to dig in deeper. And I know I'm going to learn quite a bit by talking to him today. So, Steve, how would you like to introduce yourself to the listeners?
Good afternoon, everyone. My name is Steve Pointer. I'm again a regional director at Cantor Fitzgerald. Been in the investment management space for over 15 years. I've been specifically dedicated to alternative investments, otherwise known as real assets, which is inclusive of real estate, private credit, and infrastructure over the last 8 to 10 years. So it's a pleasure to be here. Thank you for having me, Brent.
I think this is a great conversation today because I do think that real assets, specifically, are a really important place that we can be allocating resources towards. You know, a lot of times when people pretty much across the wealth spectrum come in here and talk to me, they've got in their minds, well, you're the stock and bonds guy, and that's obviously a big part of what we do. But if you're ignoring what you're talking about in terms of these other real assets, you're ignoring, first of all, massive opportunities for growth and to increase your wealth, but just a big giant piece of the economy that, quite frankly, is something that should at least get a look. So, let's start with infrastructure. I mean, how would you describe infrastructure, and how do you access this as an asset class that you can invest in?
Great question, Brent. And I think, just taking a step back in terms of what we see in the infrastructure space, infrastructure defined is really the physical assets that improve living standards and support economic development, or said otherwise, it allows the economy to function properly. I think historically, a lot of people think about infrastructure just as roads and bridges, more traditional infrastructure. But that has been much more broad in terms of the global growth trajectory and the amount of public and private investment that we've seen going into infrastructure over the past decade or more. Areas like power networks, water systems, telecommunications, energy, just to name a few sectors of infrastructure broadly. There's really three main ways to access the asset class. Historically, it's been through publicly traded securities, whether that's individual stocks in the infrastructure sector. It could be through a mutual fund or ETF, a more diversified basket of publicly traded securities, or could be through the private sector. And a lot of these private sector infrastructure strategies are typically offered by some of the larger private equity funds out there in the world. Although they've had a very narrow group of clients that have qualified for the investment, meaning that it's typically a 5 million net worth or more to access those strategies. And it's usually, $500,000 to $1 million minimum. So typically only ultra high net worth clients or institutions have had access to them. There was a study actually not too long ago that looked at the fact that the average institution holds about 8% of their investment portfolio in infrastructure. Meanwhile, the average retail investor has less than 1% because of that barrier to entry.
I think the cool thing about what you said there as well is coming out of 2022, which was a year that, those of us in the business remember was really tough for the equity markets, was really tough for fixed income markets. And what you found, looking in the rearview mirror of that, is the large institutions that you reference, or your ultra high net worth investors that you say, you mentioned have 8% of their money that are allocated toward these funds, they really fared a lot better. Volatility in those portfolios was significantly lower, and just the overall returns in what was a pretty lousy year. I mean, this is a year we had double digit losses in the aggregate bond index, for example, for the first time probably at least while we've been alive. They did really well. So can you speak a little bit to, um, I think it's kind of self-evident, I think, why people with that level of wealth or institutions are investing in this asset class. But can you talk about what some of the benefits are that got them to make that decision, whether it's lower volatility, diversification, those type of things?
Yeah, absolutely. So I think on a macro level, why infrastructure is in such high demand is number one, as real estate has gone out of favor in the last 24 to 30 months as the Fed started hiking rates starting in March of 2022. The writing was on the wall that infrastructure has been historically very stable asset class. It's typically backed by more monopolistic trends such as utilities, to where you don't have a choice whether you pay your utility bill or not. But you look back to just, recent government spending like the Infrastructure and Jobs Act, the IIJA, that was put in place in 2021, or the Inflation Reduction Act that was put in place in 2022. There's a lot of government funding that's going into infrastructure, but it's really the tip of the iceberg because it's only funding a small portion of the overall amount that we need to be spending on our infrastructure just in the United States alone to bring it up to speed with today's demand. So that's number one. It's government backed. A lot of institutions and now retail investors really like that. And there needs to be more investment to fill the void. Number two is the attractive historical returns. So we've seen that infrastructure has had a very low correlation to traditional asset classes, meaning stocks and bonds. Number two is that it has a high level of current income because it's typically contractually backed by a long-term contract that's put in place with something like a utility company. And then number three, I think this is a trend that a lot of people are looking for in their investment portfolios, is a hedge against inflation. So because of those long-term contracts, those are typically tied to an inflation metric such as CPI plus 300 to 500 basis points, for example.
Now, in terms of the size of these markets, how big is this universe that you're looking to invest in?
It's massive. So there's really three global mega trends that we see are seeing the most investment out there in the marketplace. So number one is digital transformation. So digital infrastructure is everything that's related to the number of devices out there in the world. That's something that all of us can relate to, right? Phones, tablets, computers, etc., any type of smart device. The number of devices out there, all of that data has to be then connected to a cell tower. And then all of that data passes through to a data center. So the amount of data that's being transmitted is causing a significant need or gap in the amount that needs to be spent on digital infrastructure. So that's one. Number two is energy transformation. Energy infrastructure is certainly seeing a lot of capital being attracted to that area, just because we've seen energy costs go up significantly across the globe. And the growing trend is that more governments and municipalities are looking at more low-cost, renewable forms of energy, such as nuclear, hydrogen, solar, wind, the list goes on. So that's the second mega trend. Third is the enhancement of aging infrastructure. So what we've seen over the recent decades, really most of the U.S. infrastructure alone was put in place post-World War II. And we as a country has simply underspent on infrastructure, causing a significant gap in what needs to be spent on it just to bring it up to today's demand. So that's where a lot of the government support has come from. But for example, like the Infrastructure and Jobs Act, that only accounted for about one of the $2.6 trillion that needs to be spent on our aging infrastructure, just to bring it up with today's demand. So a lot of that infrastructure is being deteriorated, and that's why you're hearing things in the press, such as trains getting derailed, bridges collapsing, highways having potholes left and right. So those are just some examples.
I'd like to touch on each of those three sort of areas that they brought up there, and ask you where you think the responsibility, or rather the opportunities are. And if you look at, say, aging infrastructure, that's a great example, because I think there's a movie, Crazy Rich Asians. I don't know if you recall that, but the woman responds. She lands in Singapore, and there's this gleaming, beautiful airport, and she's like, JFK is like, salmonella, and it's like a third world destination relative to the infrastructure around the world. And I can attest that that's the case. We've got embarrassingly bad infrastructure here in the United States. And so if the feds are in for $1 trillion, and you've got 2.6 trillion or so that needs to be spent in this capacity, um, is there $1.6 trillion of outside investors globally or here in the United States that are going to fill that gap? And if so, is the benefit to them, um, how are they getting paid? Are these taxpayer funded projects that are basically backed up by the investors? Or just give me the background on how they work.
Yeah, so I believe the gap needs to be filled by both public and private sector investments. That's the only way that we accomplish these goals. And to your point about just the deterioration or current, you know, status of U.S. infrastructure, the United Nations puts out their Sustainable Development Report Card every three. Sorry, let's scratch that if you don't mind.
No worries.
Um, let's restart here. Do you want to re-ask that if you don't mind?
Yeah, no problem, no problem. Where was I about the gap?
Yeah.
Bill, where should I fill in there?
The gap that needs to be spent, where does that come from? That's
Okay,
from
got it.
Yeah.
Okay.
Bingo.
All right. So we'll kind of editing team will figure out how to put this together. All
It's
right.
no
So
problem.
all right. So you mentioned, in terms of aging infrastructure, and I can attest to the fact that, having spent a good chunk of time around the world, where, you look at what we've got, whether it's rail, whether it's landing in airports, it doesn't matter. It's clear we're falling way behind. I mean, this is like a developing country compared to other parts of the world where they've got this pretty much nailed down. You threw out the number there, about $1 trillion picked up by the feds, about 2.6 trillion of need. So where does that gap get filled, and how does people, if you're an investor that's looking at getting involved in this, how are you going to get paid? What does that return look like, or that risk return, I should say?
Great question. So the only place where that gap gets filled is from the vehicles that I had mentioned, whether it be public securities or private investments. So what we've seen just over the last decade is that private infrastructure has delivered about a 5% yield with a mid to high teen total return. And that income has been very stable, even in the GFC in 2008, 2009, as well as at the onset of COVID, coupled with public infrastructure, which has delivered just north of a 10% cumulative annual growth rate, with a higher yield than global equities and a lower volatility to global equities. So that's kind of the holy grail. If you can deliver higher returns with less volatility, that's very meaningful for a client's portfolio. I think just looking at the current status of our infrastructure here in the United States, the American Society of Civil Engineers puts out an annual report card, and they actually grade various areas of infrastructure. We, in 2021, as of the most recent report card, received a grade of a C minus. I don't know about you, Brent, but if my kids came home with C minus grades, I wouldn't be too happy about it.
Yep.
But a lot of people hear C minus and say that's pretty bad. That's actually an improvement of where we've been in previous years. We've historically had a D on our report card. And I'm talking about areas of infrastructure like aviation, bridges, energy, ports, stormwater, drinking water. So these are really critical areas that affect our daily lives.
And I guess the cash flow, the return kicked off these things is coming from user fees. I mean, you land in an airport, there's a user fee. You go across the bridge, there's a user fee. Is that how the money's being generated?
Correct.
Okay. Now let's talk about the second one that you mentioned, energy. So you're talking really about the, I guess, the integrity of the grid and also how you're delivering power. I'm assuming that's what you mean. And I'd read, actually put on LinkedIn a week or so ago, a couple interesting stories where, all of these companies are so heavily invested or have such a need for data centers. These data centers are enormously power intensive. And so they're actually signing contracts now with people doing like micro reactors, to bring nuclear at a very small scale to exactly where it's needed. Obviously, there's wind and solar and all the green stuff that we hear about. But are these the kind of projects that you're talking about when you're talking about energy infrastructure?
Yeah, absolutely. And, AI is the biggest talk among both public and private markets right now. And I think to your point, those data centers are incredibly energy, energy, sorry.
Well, they're massively energy intensive. There's no question about that. And as I read these things, I wonder. There's obviously a huge mandate to put more electric on the grid. Whether it's an electric vehicle, whether it's you name it, an electric stove, as opposed to some other solutions. And we've been in a position, and tell me if you think that these kind of funds that you're talking about investing in address this to a point where really since maybe like 2006 energy consumption in the US has kind of leveled off, and we've been taking some power production offline. But now it looks like, based on what's coming, you have this explosion of demand, and there's got to be a way to meet it. So, like, to me, that's kind of like a one and one meets infinity there in terms of what the opportunity set looks like. Not to mean it's a great investment, but it looks like there's a huge opportunity there. Is that the kind of things that we're talking about?
We agree, yeah. And I mean, you look at real estate 25 years ago relative to where it's in today, even after a major repricing over the last 2.5 years. And infrastructure, we believe, is what real estate was 25 years ago. It's a global growth opportunity, and it has incredibly attractive historical returns. It's just finding a way to unlock that for the average investor. And I think we're heading in the right direction.
So, we open this by talking about typically investors in these kind of projects. Now, I want to get into the nitty gritty about how different people at different economic levels can access some of these investments. And historically, ultra high net worth investors, 5 million plus, you've got institutions, minimum ticket to get into these things, $1 million in some cases. What does that look like now? Like, what's the offering that is available to people from, say, institution to ultra high net worth on down to retail, which you'd mentioned retail investor earlier on in our conversation? What does that look like?
Yeah, so coming back to my points earlier, you can access infrastructure through public markets via publicly traded stocks, such as utilities, which have performed exceptionally well in public markets over recent months,
Yeah.
especially expecting that rates are going to come down. That's historically been a really good catalyst for performance of utility stocks. Number two is, to your point, private infrastructure funds. We found that the average private fund offered by a private equity firm is about 2.4 billion in size, but the average investment within that given fund is about 800 million. So you only get an average of 3 investments within a given fund that requires a very high minimum. So that's a lot of concentration. We believe that that's a lot of risk for the average investor. The third option is really through a 1940 Act vehicle, otherwise referred to as an interval fund, which is essentially just a mutual fund, but allows for investment across private markets and public markets. And that fund is acting as that high net worth or ultra high net worth investor with a $25 million threshold of investable assets, to where they're accessing those private funds on behalf of that investor in scale. So it's allowing diversification across private markets and public markets, equity and debt. And you can also be allocating to private investments across primaries, secondaries, and co-investments, taking a hyper-diversified approach to the asset class.
Okay. So in terms of, and let's bring it down, I want to bring it down to that point, but if you have Let's start with an ultra high net worth investor. Maybe they've got 25, $30 million of investable assets. They think they want to allocate maybe $1 to $2 million towards this kind of investment or these strategies, which are obviously there's not a one-stop shop here because what we've talked about is several different things that fall into this broad umbrella of infrastructure. What's the most efficient or the best way from either a tax standpoint, efficiency standpoint, or a real potential return standpoint for them to get involved and get access to these investments?
So my answer in short would be both public markets and private markets exposure. With $2 million, I mean, you can get good diversification out there in the marketplace. You could be allocating some of that to private infrastructure and still get broad diversification across public markets as well. Public markets, you typically have more liquidity, right? It's priced on a daily basis. You're going to get more alpha or upside of the portfolio because it's priced every day. The downside of it is that comes with more volatility. On the other hand, you have private markets that are not priced on a daily basis. They're less liquid, and they typically have a 5 to 10 year shelf life in order to get that liquidity. So, I think they both make sense for higher net worth investors.
Now, these private market funds, they tend to be fairly diversified, or are they dealing with a specific area that they're looking to solve for?
Typically a specific area, correct? Whether it be digital infrastructure, energy, aging infrastructure, and they can be structured in a variety of formats, typically a GP, LP private fund.
Got it. And in terms of Cantor's offerings out there right now, and this is obviously not an offer to buy or sell at all, but what's Cantor offering in that private space? And then we'll go down to the fund space below that.
Yeah, so Cantor Fitzgerald is the advisor to a 1940 Act interval fund called Cantor Fitzgerald Infrastructure Fund. This is a vehicle that is priced daily at net asset value. It provides quarterly liquidity. That's up to 5% per quarter, 20% per year. And we're receiving distributions from the private funds that we're investing in on a quarterly basis. So that's at the same rate that we're passing through that cash flow to investors. And we're targeting those three main food groups I mentioned: digital, enhancement of aging infrastructure, as well as energy transformation.
Well, let's dive into that a little bit. So when you say for our listeners, 1940 Act, we're essentially talking about mutual fund structure, correct?
Correct.
But just in your case, it's a mutual fund with daily pricing or daily price transparency, but you're a little stickier in terms of what the liquidity available is, correct?
Correct.
And what kind of do we need to be an accredited investor for that, or what's the threshold to get involved in those?
Non-accredited investors, and depending on whether it's retirement or non-retirement accounts, it's about $2,500 minimum, and it's available on the major custodial platforms via Schwab and Fidelity.
I think that one of the cool things that I've seen in this business, which is why I was really kind of drilling down from that ultra high net worth investor institution all the way down to a retail investor, pretty much all of them, which can carve out a limited portion towards this, is that one of the amazing advancements we've had in this industry over the last 10 to 20 years is you have all these strategies that were formerly the domain of extremely wealthy people or large institutions have been democratized down to that basic level, which I think is incredibly exciting. So in your fund, how many private funds are you typically? Obviously, I know it changes on an ongoing basis, but how many funds are you typically invested in?
We're currently at 9 private investments in the portfolio, and about 50 publicly traded securities.
Okay. So yeah, combination of the two in there.
Given our simulations, we've looked at a variety of models, and we found that we believe the most efficient balance between public and private markets is 70% private, 30% publicly traded securities that optimizes for the lowest level of risk, but the ability to provide the highest level of return in return for that risk.
Got it. And in a given year, I'm guessing you probably have one of these private funds is closing out and you're entering into something new.
As those private funds mature,
Yeah.
yes, we could then roll that money over into something new. And the goal is ultimately to reduce the amount of cash that we have on hand and stay fully invested at all times. But we also want to keep a very strong pipeline of good opportunities that we're coming across and provide that hyper-diversified approach to infrastructure.
Now, typically, I know that the past does not look like the future, but what I'm most interested in is overall correlation to equity markets in this fund and also fixed income markets. How closely correlated, if you are holding some utilities and things like that in the fund, how correlated are you with the S&P roughly?
Yeah, so in general, infrastructure has about a 0.08 correlation
So
to
none,
public equity.
essentially. Yeah.
Yes, a negative correlation to fixed income, and only about a 0.5 correlation to even real estate. And at times, infrastructure can have overlap with real estate. Things like distribution facilities or data centers or cell towers. Those are physical assets that some may view as real estate, but we view as more infrastructure based.
So what that means to our listeners, if we're throwing numbers out there, if he was telling me the correlation in the equity markets was a 1, the S&P goes up 10%, you can expect this thing to go up 10%. At 0.08, you're talking about a nominal. It's essentially non-correlated completely. And in terms of your bond portfolio, it's a negative correlation, which means if your bonds are going down as they did in 2022, generally you're getting a tailwind with assets like these. Is that a safe assumption?
Yes.
Okay. Okay. Now, while I got you here, and we'll wrap up in about 10 minutes or so, but can we dive in a little bit to the real estate offerings that you guys have as well?
Happy to.
Okay. So give me, give me an idea of what this world looks like. Again, starting with your high net worth, ultra high net worth institutional investor, all the way down. What you look at the different opportunities that you have in terms of investing into real estate. Where do you guys see at that really high net worth level opportunities to either the 1031 exchanges or opportunity zones, or can you speak a little bit to that? And I know we're digging into stuff that we could probably spend about 3 hours talking about. Is there a way to condense that into a shorter conversation?
Yes, absolutely. So, just to kind of recap where we've come in the commercial real estate space, many of you listeners out there are hearing about commercial real estate that's painted with, I think, a broad brush out there in the media as if real estate was all office or retail. Me and you, Brent, know that that's not the case. So not all commercial real estate is created equal. Our highest conviction asset classes are certainly multifamily, given the supply and demand imbalance. More people are renting for longer, and home ownership in the United States has progressively gone down. So the need for rental housing has progressively gone up. And we believe that that's a trend that's not going away. So that's been not only one of the most stable asset classes over previous decades, but also one of the best performing. Secondly, is industrial real estate has been one of the top performers. And we believe that that's going to continue because of that Amazon effect. More people are getting things shipped to their front door. E-commerce is at an all-time high. All of that has to be stored in a dry or cold storage distribution center. So that's been a lot of institutional money has been chasing that type of real estate. And then you certainly have more specialized sectors such as life science, where people or companies are developing vaccines, pharmaceuticals, medical equipment. So those are really the three segments that we find most attractive right now. To your question about how ultra high net worth investors are accessing real estate, I think we're seeing more institutional and high net worth investors accessing real estate from an opportunistic standpoint because real estate has repriced peak to trough 25% over the last 3 years. And this is a very attractive entry point, in our opinion, to be investing in real estate, both from a diversification standpoint, but also from a steady cash flow, tax efficiency, and growth standpoint as well.
Now, that's obviously a great opportunity for new cash, but let me throw a problem that I know that a lot of people here, for sure in Arizona, have, and you tell me if there's a solve for that. Let's say that you have a individual that has a piece of real estate, maybe a commercial property, and it's worth $15 million or $10 million, and they've depreciated it down to maybe, their basis is now down to $1 million or $2 million. They really want to get diversification out of that single piece of real estate, but they don't want to pay that giant hit to the tax man. They can obviously 1031 exchange it into another target property, but what is there an opportunity for them to diversify that into a broader pool and defer that tax to a future date?
There is, yes. So there's what's called a Delaware statutory trust, which is recognized under Internal Revenue Code 2004-86 as qualified replacement property for 1031 purposes. So this is a type of business trust that's set up to hold real property, and the IRS allows a client to sell their property, send the money to a qualified intermediary, which is held in essentially an escrow account. And then from there, they would exchange into this type of trust, which would satisfy their exchange. They would then defer their tax, continue to receive cash flow until that asset is sold in the trust. And that would start their process all over again. They could cash out and pay the tax or do another exchange.
And now there's no life cycle with a DST until the property is sold, meaning there's not an end date on it until the property inside is sold. Am I correct on that?
There is an end date. So the IRS put a number of restrictions in place. They're referred to as the 7 deadly sins.
Okay.
And that says that you have to sell the property before the debt matures. So us, as well as other sponsors, tend to put 7 or 10-year interest only debt in place, which gives you the longest runway to acquire, manage, and sell that asset before the debt matures. So you don't want to sell it too quick, and you don't want to hold on to it for too long and be in a position where you're a forced seller.
Now, is there an opportunity then to, if we know we've got a life cycle on the DSTs, is there an opportunity to transfer that asset, still defer the taxes, into a more broadly diversified evergreen fund?
Great question. So there has been a proliferation of Section 721 in recent years being used in conjunction with the DST. And Section 721 has been in the tax code for many, many years. And that says that in conjunction with a DST, somebody could sell their current investment property, exchange into the DST, and then after holding their interest in that DST for at least 2 years or more, we would then convert their interest into operating partnership units of a larger diversified perpetual REIT, which would allow them to defer the tax indefinitely and still receive a step up in basis for their heirs upon death.
Okay, so basically now they've got shares in a much more broadly diversified fund. If they can sell all or none or a portion of those shares, and should they hold that fund until the end of their life, they get the step up there.
Correct. The downside of the 721 is it prevents you from doing a future exchange, but so long as you hold those shares indefinitely, you receive that step up. If you decided to take liquidity at any point when the operating partnership unit is converted to common shares, that is the taxable event from an IRS standpoint.
So not the conversion not the conversion, just your choice to take liquidity from it.
It would be the investor's choice. So
Okay.
the REIT would essentially have liquidity on a monthly basis up to a certain percentage of the overall shares.
Got it.
And if the client requested a redemption, we would then have to convert their OP units into common stock, and that would be the taxable event.
Got it. Got it. Very cool. And I think that's particularly here for Arizona, as I mentioned, I think that's a excellent strategy for people to be thinking about and considering. How about, you hear so much about opportunity zones, and we'll hit on this, and then I'll close up with you. But what are some of my understanding is that a lot of the stuff when the opportunity zones were put in place, this is going to sunset in 2026, which is not that long from now. And is that looking like that could be extended, or am I completely wrongheaded in thinking that? Like, where's their potential to make use of these now?
Yeah, the answer is that I believe that the Opportunity Zone program has come a very long way. There's been over $100 billion invested into the Opportunity Zone program since it was created in the Tax Cuts and Jobs Act in 2017. And if you remember, it received bipartisan support, which is very unique. You had Cory Booker on the left, Tim Scott on the right, who put it in place. And now that it's seen investment, significant investment over the last 5+ years since the IRS rolled out the rules and regulations, we believe that there is a likelihood that it will get extended before the Tax Cuts and Jobs Act phases out, before the end of 2025. So for those of you listeners that aren't familiar with the Opportunity Zone program, this allows for any type of capital gain, short or long term, to get reinvested within 180 days from the date of sale. And by doing so, depending on your state, it allows you to defer the tax until December 31st of 2026. And then after 10 years of being invested, any of the growth from the appreciation of that investment is 100% tax-free. So this has been regarded as one of the most lucrative tax benefits as it relates to real estate since Section 1031 was created 100 years ago in 1921.
Now, but if you entered into an Opportunity Zone investment, say in 2020, were you kind of too late to the game in terms of indefinitely or eliminating that tax, because the bill's still going to come due the end of 2026? Am I thinking correctly about that?
Not too late. Some of the early tax benefits had phased out by the end of 2021. What still lives on is that deferral. Everybody has the same deferral up until December 31st of 2026, but everyone's 10-year clock is what's different based on the date that you reinvest into a qualified Opportunity Zone fund.
And the hope would be that Congress or the feds do something to grandfather you in and extend that 2026 date. Is there chatter about that up in Washington?
Correct. Yeah. The hope is that because it took the IRS 2 years to roll out 3 rounds of regulations in 2019, prior to that, there was very little to no activity, that they will potentially extend the deferral from the end of 2026 to the end of 2028. And then the 10-year hold to maximize the tax benefits would still be in place.
Awesome. Well, Steve, this was illuminating for me, and I always learn a lot when I talk to you. And I think that it's really, the conversation we had today is really just a teaser in terms of the opportunities that are out there in obviously infrastructure funds. We dove into that a little bit, and also something I think is really important in terms of an opportunity set that you have, or potential to make a pretty good investment if you've got new cash, but also for the listeners that may have, highly appreciated real estate that's out there. There are potential strategies that you have to at least make the tax hit at the end of selling that thing minimal, which is something we all like to look after. So yeah, so if anyone has any further questions or wants to learn more about Cantor Fitzgerald and what you're offering, what's the best way for them to learn more about you and your company?
You can visit www.cantor.com and view the asset management section of our website, or you can obviously direct your questions towards Brent and we can set up time from there.
Excellent.
That is great. Brent, thank you for facilitating this conversation. Steve, thank you for making it plain. Actually, it was an easy conversation to follow. Brent, you and I've talked about this in the past. For people who want another investment besides stocks or bonds, alternative investments offer a really interesting and potentially exciting way. People obviously have to decide for themselves. And in order to do that, they probably ought to talk to you. How could they get a hold of you if they're interested in exploring these avenues and these opportunities?
Yeah, before I share the contact information here, I think that one of the things that I touched on during our discussion is a lot of these alts were just not accessible to everybody for a long time. And there's a ton of strategies that are out there now that are as accessible as a large cap growth fund. You know, these are not, these are investments that are not just a domain of large institutions and the super rich anymore. There's a lot of opportunity that's out there for pretty much every investor with these asset classes. But yeah, if anyone would like to follow up with me or want to really dig into a topic that I've got probably far less knowledge on than Steve, I can definitely get to Steve as well. My number here in the office is on 602-255-0555. Really active on LinkedIn. You can search me on LinkedIn. Our website is tws.finance, and that has pretty much every conceivable way to get a hold of myself or a member of the team. But would love to hear from you if you have any follow-up questions or you want to chat about anything else.
Yeah, that'd be great. And for those of you who are listening to this podcast who are not subscribers, the first thing you can do is an immediate thing, which is hit the follow button. Become a subscriber. That way, every time Brent drops a new episode of the podcast, you're notified. Then you can give it a listen. It's that simple. Really is that easy. The thing I would ask is that if you like this podcast, share it with people. Tell folks about it, because word of mouth promotion is very welcome, and it's a really valuable tool, and we would very much appreciate it. Until next time, I'm Bill Tucker on behalf of Brent and everybody at TWS. Thank you for taking the time to listen today, and we will remind you that you can go out today and make today a great day or not. The choice is yours. Use it wisely. Until next time.